Theft or incompetence? Current governments say they will fix the tax system and inflation. No doubt they think the current settings are great. I believe that most seem to be concentrating on ways to increase their spending power to build public servant empires, and many issues remain unaddressed in their tax settings. The cost of a new home is 50% tax. Insurance premiums are 50% tax in NSW Australia. If all prices, wages, and interest rates adjusted with inflation, then no one's purchasing power, profits, or real loan payments would change. However, if the economic variables do not move exactly in sync with inflation, or if they adjust for inflation only after a time lag, then inflation can cause three types of problems. Inflation can cause unfair wealth and purchasing power redistributions, blurred price signals, and difficulties in long-term planning. For example, anyone who has financial assets invested in a way that the nominal return does not keep up with inflation will be affected by inflation. If a person has money in a bank account that pays 4% interest, but inflation is at 5%, then the real rate of return for the money invested in that bank account is -1%. The problem of a nominal interest rate can be worsened by taxes. In some countries, income tax is charged on the nominal interest received in dollar terms, without an adjustment for inflation. Thus, the government taxes a person who invests $10,000 and receives a 5% nominal rate of interest on the $500 received. No matter whether the inflation rate is 0%, 5%, or 10%. If inflation is 0%, then the real interest rate is 5% and $500 is a gain in buying power. If inflation is 5%, then the real interest rate is 0 and the person had no real gain, but owes income tax on the nominal gain. If inflation is 10%, then the real interest rate is -5% and the person is actually falling behind in buying power, but would still owe taxes on the $500 in nominal gains. Retiree savings. If you are on government pension in Australia, the deeming rate set by the government can affect how much deemed income is calculated as taxable, potentially impacting your benefits. Even if your actual return on savings is lower than the deeming rate, the higher deemed income might reduce your benefits.